Ladies and gentlemen, I'm going to structure my entire six-figure dividend portfolio by 2021. It's taken me a little bit of time to figure all this out, but I think I have a final plan, and then we're going to head over to the computer. We're going to analyze the dividends in the actual portfolio as it stands today. So let's jump. Who ready? Welcome back, my passive income investors. Like today, this is going to be an exciting day because I haven't done this yet, and it's taken me a lot of analyzing over a lot of different things, and I'm trying not to overmanage my stock portfolio because it's something that I feel like I've been doing lately. So I'm trying to come up with a very structured plan that's going to help me just kind of fill out the next year and a half of what I'm going to be doing, because as you guys know, I've been looking into like different REITs, real estate options, if I can buy a house, if I can get a line of credit. I've been looking at Grant Cardone's fund, and I just want to break some things down for you really quick. I found out that I can't really buy real estate in the US without paying crazy taxes, especially through what is called an LLC. I would be better off going to the States and buying a property individually for myself than I would be buying it into something like Grant Cardone's fund. I even looked into Fundrise. A lot of you probably use Fundrise, but the problem is you get double taxed, especially if you are out. Well, double taxed if you're Canadian for sure, because you're going to pay the tax in the US. You're not going to get any tax benefits, and then you're going to pay income tax when it comes in here. And before you know it, you probably paid somewhere between 20 to even 40% in taxes, guys. It's absolutely staggering. So what I've decided to do over the next year and a half, I think this would be the best decision, because the only other option I found is like Empire Flip or something I've mentioned before about buying an online business. I could take that route. That might be the best alternative I've found so far, but then that comes to the stipulations of just waiting for a business to come up, analyzing the businesses, and then I have to set time aside to put into that business to either grow it or make sure it is sustainable. And personally, I don't know if I have the time to do that. I'm kind of thinking about it. I'm trying to manage a big show, a theater rental. I'm trying to manage this YouTube channel that I really want to grow. And I'm also trying to manage doing all my magic and everything else and DJing and my full-time job in between. So I've kind of come to the conclusion that, you know what, maybe I should step aside a little bit, not over trade any of this, and try and find a way to structure this where I can do little incremental things over the next year and a half that will get me to where I want to be, but where I won't feel like I'm over trading. And this is a structure that I have come up with, guys. And if you live in the US, I'm going to show you how you can do this as well with the structure you currently see. And I hope you guys can see this. My 2021 plan basically consists of me coming up with somewhere between $140,000 and $150,000, essentially. So I'm going to have to come up with quite a healthy chunk of change. I got about $111,000, $112,000 sitting in the account already, which means I need to make about another $30,000 to $40,000 to reach this specific milestone. But I want to break down the accounts, what I plan on doing here, guys, because I'm going to try and take all the advice I've learned from everybody and kind of plop it into this portfolio to the best of my moral comfortability, I'm going to say, guys. Now, we're going to start looking at the tax-free savings account. If you live in the USA, this is called a Roth IRA. So a tax-free savings account lets you basically pay tax on money you make. If you put it into this account, you will basically make everything in here tax-free. So you pay tax putting the money in the account, but once the money's in the account, it makes you money tax-free. So you want to max these accounts out, and in the US, it's called a Roth IRA, guys. But we're going to go through this real quick and how I plan on, these are the specific positions I want, and my entire portfolio is going to be structured basically over, we got 1, 2, 3, 4, 5, 6. We're going to have about 7 different sectors by the end of this in my portfolio. I think it averages between about 15% in each sector. So let's go over this. We've got the tech sector, many of you know, and we are going to analyze this in my portfolio as well. Just bear with me here, guys, while I break this down for you. We've got Apple, Microsoft, Tesla in my tech, Canadian Imperial Bank, Bank of Nova Scotia for my banks in my TFSA here. We're going to have, and that would be the banking sector, obviously financials. We got Northland Power, Southern Company for my utilities. We got RioCan and GEO for my REITs, and BTI and MO for kind of my drug sector. And this is just my tax-free savings account. And I'm going to start leveraging these stocks around because, as you know, you can only put a certain amount in this account. And in the next 2 years, I'm hoping I'll have around 100,000. And the way I see myself getting to 100,000 is I sit right now in this account about 86,000-ish, 85,000. So if I'm able to contribute 6,000 at the end of this year, that would take me to 91. I'll be making about another 2,000 or 3,000 in dividends, which would take me about 92, 93. And then hopefully with a little bit more capital growth, and by the end of 2021 going into 2022, I'll be able to put another 6,000 in, plus I'll have made another 4,000 in dividends, it'd be 3 or 4,000 in dividends, which would take me well over that 100,000, or really close to that $100,000 mark in the next year and a half, which would allow me to basically fill out all these positions. These would be the max way I would see these positions. So these would be fulfilled, and then my goal from there on in is to try and make somewhere between around 5% at least in this account, which would be about $5,000 on $100,000. And then every year, because they let you contribute, it'll be around 6,000 and probably increasing, because they tend to increase that number over time. I will contribute 6,000, plus I'll be making 6,000 in dividends, hopefully in this counter, 5 to 6,000, which would allow me to buy one brand new or 1 to 2 new stocks every year. So to mitigate the risk and not keep buying into these over time in case something decides to falter, all the money this spits out will just be put back into a new company. So every year I can add 1 to 2 new companies to this portfolio in perpetuity going forward, and that will slowly snowball and increase depending on what companies I find and decide to buy over time. Now moving on to the RRSP. This is a new account that I opened, a registered retired saving plan. In the US, it's called a 401k, and it is my least favorite account, and it should only be used if you can find a specific way to make it fit. I honestly think this is better off later in life, but because if you are like me, maybe you're living at home with your parents, you live at home, you got nowhere to go, and you're kind of just thinking to yourself, well, I kind of want a house or maybe a rental unit or something. Well, this is a good way to actually do it if you live in Canada. Canada offers you a plan to basically pull a line of credit or mortgage off your RRSP to buy a house or fix up a house if you're a first-time home buyer. So what I'm going to do, and the best thing about these accounts, is if you make money today, instead of paying tax on it, you put it into this account. You can't touch it till you're 65 without getting penalties. But up to $25,000, guys, what I've been told is you can mortgage against it, but it depends on how safe the investments you make are. So to rip the Band-Aid off today, I'm going to start adding about $10,000 this year and next year to bring my taxes way down. So it's going to help me defer the tax today at hopes in the future I will be a home buyer somewhere between the next 3 to 5 years. And I hope to see about $20,000 in this account, and hopefully I will grow into 25. And I'm going to buy only index funds. And that way I can start tracking my actual TFSA against the basic indices. And the indices and the index funds I'm going to buy, guys, are the Canadian version of the Vanguard 500 index funds. I'm actually going to divide it up between both. So there's VOO, and these are the S&P 500 indexes, which makes up the 500 largest companies in the U.S. and a very safe, historically guaranteed almost way to make money in the market over a 20-year time period. We're going to be looking at VFX.ca, so that's the Canadian version of the Vanguard 500 index, and then I'm going to divide some of it up into VOO, so I have a little bit of US divided and a little bit of Canadian divided, and you're probably thinking to yourself, well, why am I not buying Canadian index funds and just US? Well, personally, I'm not the biggest fan of the Canadian index funds. You can go take a look at them and compare them to the US. They're not nearly as attractive. But over time, as these accounts grow, and I might continue to add more to this, I will probably start looking into foreign index funds and things of that nature, and just trying to diversify even into maybe some high growth index funds or mutual funds, something like Dave Ramsey would recommend. And this would be my long-term savings. And the only reason I'm going to contribute to this is to divert taxes today in hopes that I can buy a property tomorrow. And this will save me from paying taxes on $25,000. And the cool thing is though you're taking out a mortgage against it, this is still going to grow and make you money all the way into your retirement, so long as you don't touch it. So that's what I'm going to use to save myself some tax money this year. And then the last thing I'm going to do is in my regular trading account, I'm going to try and keep 1 to 2 stocks in there over the next 2 years. Every year I'm going to try and add about one position that'll be worth about $10,000 to here. And then essentially I'm going to call that a day, because I don't know what I'm going to be able to. This is the stuff that I'll have to pay taxes on. And I don't know what these companies will be yet. They could be anything. They won't be REITs. I'm going to try and keep the REITs in the tax-free savings account, because REITs you end up paying specific taxes on that are a little different, and they're a little higher than regular. They're not, I don't think they'd classify as qualified dividends. You do end up paying a little bit higher of a tax if it's not in your TFSA. So I'm not going to add any REITs. I'm going to make sure all the REIT positions stay in my tax-free savings account. I know I was just talking about a company called TNT. Whether I add that or not to this account, it might happen. I don't want to take on too much risk, because those are the kind of companies that have fully extended themselves. I love the real estate they own though, so I'm going to continue continue to analyze it, and it may become a position in here, and I might mix it in somehow, but I'm not there yet, and I'm not going to rush it. I'm just going to keep looking at these and analyzing them. I just like RioCan personally. Yes, it pays a lower dividend, but it has room to grow it. It's just a well-rounded company that's been around for a lot longer than TNT. But again, you're looking at a way lower dividend, but a much more stable company, along with probably a bit more of a stable chart as well. Now, moving on to the final thing here, guys. At the very bottom, I have credit. I need to start building my line of credit, so if I can, one day I could probably get a mortgage. It's something I'm having a hell of a time with lately. I still got some meetings to do with the Royal Bank. I'm still trying to find the right paperwork because Canada Revenue Agency doesn't have it on the CRA's website, which takes a long time to get into, which has been really annoying to me. But aside from all that, guys, in order for me to actually sustain this plan, so let's get away from the CRA and the credit. I'm hoping I'm going to get about a $7,500 line of credit to start with at 10%. I might not use it, but you can increase it every few months. So I'm going to fight to get that as soon as I can. But looking at how I'm going to achieve all of this, guys, in order for me to get to where I need to be, I need to come up with about $1,600 a month. $1,600 a month is a lot, but the fun thing about that $1,600 a month is that doesn't include the dividends. So this is the number that I have to come up with without actually contributing any dividend aspect to it, and I'm going to be making about $3,000 to $4,000 and well, I make about, like I said, around $400 a month in dividends, an extra $4,800 a year that is not added to this number. So when you deduct that $4,800 extra a year, you can just minus 400 from 16, we get to about $1,250 a month. And like I said, I need to put about $15,000 away a year to achieve what I want to achieve here. So that is the main goal, guys. So let's head over to the computer. I want to show you the actual stock positions and how I'm going to remanage them, because this is all hypothetical. This doesn't fully exist yet. Some of these companies are already fully finished out, but let's go take a look at the account and finish breaking this down for you guys. And let's go from there. Come on. All right. So here we are, guys, in the tax-free savings account. Then we're going to go over the plans for the regular account, and then we're going to go over the plans for the RRSP real quick, guys, just to give you a breakdown before we look at the dividendos here. Now, the problem I've done here is I've over-leveraged. I've come to the conclusion that I've over-leveraged into some companies, including the Canadian Imperial Bank and Bank of Nova Scotia. So what I'm going to do is sometime soon I'll probably sell Bank of Nova Scotia. I'm not down too much on it, but on a little hop. It'd be nice to see this get up a little higher. I'm going to take about 2,000 or whatever equals down to 10,000. Same with Canadian Imperial Bank, and I will use those companies to position into probably RioCan. What I'm going to do down here is Apple continues to become a high flyer. When this thing pops up a little bit more, like I said, over 210, we're going to leverage this down to buy some more BTI and MO to add to the positions as well. And then we're going to start finalizing this account by just basically draining the dividends into the companies that I want to see finished. Now, what do I call a finished company? Well, Bank of Nova Scotia is finished because it's reached the 10,000 mark. And I've gone too far beyond it. Canadian Imperial Bank, I'm really happy with Northland Power. It's one of the first stocks I've ever held. It's done amazing. I'm not going to leverage any more out of this because it makes me essentially $50 a month, and it's a dividend that is paid monthly, and we'll look into that in a second. So the way this is going to be weighted average is it's probably going to be about a 60-40-ish. I'll probably be 60% more average into the U.S. than the Canadian markets, and I'm okay with that. It's just the stocks that I like more in the U.S. The Canadian market has a little bit more of stagnant growth. I'm actually shocked that I found a company like Northland Power that is growing the way it is growing, especially for a Canadian company. It's kind of nice. I haven't owned Shopify, which is a Canadian company that's doing amazing, but I'm looking for dividend yield, right? So it's hard to find good cash flowing Canadian companies that also have good equity growth behind them. But let's keep looking through here, guys. So Apple is definitely done. I'm going to pull about, this is in US dollars, by the way, so I'm going to pull this down to about 8,000, which would be about 10,000 Canadian, and it'd be the same amount that I actually have in Microsoft, because Microsoft sits at 8,000 US with the gains it's had, so I'm not going to add any more to Microsoft. I wouldn't mind adding a little bit more to SO, but we're really going to start looking at building out BTI and MO. I really want those positions to finish out my portfolio, and then we're just going to spend the next year and a half just trying to get this over 100,000, because the combined total in this account as it stands is, like I said, about $85,226. So, like you said, as I've said in the future, guys, you can see that at the end of this year, in 6 months, I'll be able to add 6,000, which takes us to 91. I'll be making about another 4,000 in dividends next year, which would take us to what, 94,000. Plus, I'll be able to add 6,000 at the end of that year, which would take us to an easy 100,000 by 2024.
2021, fully filling this out. And then, like I said, I'm going to take the drip positions and then re-add one new stock, 1 to 2 stocks a year, probably one Canadian and one US is what I'll try and focus on. Now, moving into the regular account. This account, guys, is the account that I'm going to have to pay tax on, but I want to break down to you how I plan on, because this is the managed account. This is the most annoying account. I've got about $4,140 from selling Constellation brands in here. The account's down a little bit, but the total valuation is $26,000. So it's the $4,000 plus the book value of the stocks that I hold. Tesla's the company I got to get into my TFSA as well. Over that same time period, I'll probably use some of those Apple shares to pick up a Tesla too. But what I need to do here, guys, and what I'm looking at doing is, because I'm not fully certain I'm going to buy an online business with this money. What I think I'm going to do instead is I will liquidate down these companies, and as I liquidate them down, I'm going to start adding them to my tax-free, or my RRSP, not my TFSA. I'll start putting some of these positions into my RRSP up to probably about 10 or 15,000 this year, and that's going to save me about 3,000. It'll save me around 3,000 to 4,000 a year this year alone in taxes, which is huge. I mean, that's like a full trip somewhere that'll be just sitting in an S&P 500 index making me money, which we can see I've already added about $25 to this account. Not a huge amount. And what I want to do is, like I said, keep it about a 50-50 split between the US and Canadian stocks. So that way I'm fairly averaged against the Canadian dollar dropping. If the Canadian economy grows, then I'm leveraged to do well here. If the US economy does better, I'm leveraged to do well there. And then over time, maybe start buying some growth index or mutual funds, or start buying some foreign weighted index funds. And I'm going to use this money just to be able to buy a house down the road. And I don't want to put more than about $25,000 to $30,000 in here over the next year and a half. And like I said, $35,000 to $40,000. That's going to be a huge tax savings, guys. That's going to save me around $10,000 over the next 2 years, which is going to be huge. And then, and then what I'm going to try and do is keep about 10 to 20,000 a year in this account. For this year specifically, I'll probably keep about 10 to 20, which I will pay tax on, but I want to keep growing this account because these are dividends I can spend, but they are taxable dividends. So I want to keep this as low as possible, pay as least amount of tax as possible on this, and then also find a way to mitigate tax payments, but also be able to buy a house in the future. And I know this probably sounds confusing, but it's taken me a long time to get this far, guys. So I hope you are learning something. Slap a like if you're learning something here, but let's take a look at the dividends. We'll head over to the beautiful dividends here, guys, and see what we're not making. I haven't added this up yet today. The entire account's worth around $111,600, I think, as of this moment. And we can see the dividend income as it stands here, guys. I'm really happy with these current payments. I'm happy with Canadian Imperial brands. I'm like thinking tobacco and Canadian banks here. But Canadian Imperial Bank is currently sitting at 4.8. I'm really happy with these dividend yields on the banks. I'm just going to start scaling down on the positions. Northland Powers, these are finalized positions. I will not touch these here going forward. And to mitigate risk, I want to use these dividends to buy other stocks throughout the year, as I've said. So these are all tax-free income stocks, by the way. My U.S. weighted stocks, I do have to pay a 15% withholding tax on these. It doesn't matter that they're in my tax-free savings account. And I think it's automatically deducted. Don't quote me on that. And if it's not automatically deducted, I can promise you that it's not a huge portion of this, which is why I'm trying to do a 50-50 split to keep it even. If I'm too overweighted U.S., I'm paying too much tax. If I'm too underweighted, I'm not getting the benefit in case the dollar drops or rallies or whatever happens, right? So, I mean, it's nice to have this mitigated currency divide. But the problem is I like the companies in the States more than I do here in Canada. They're just better. I just think there's better options. The U.S. economy is bigger. It's got more track record when it comes to some of these huge companies like Apple. But Apple, I'm going to start scaling down, and like I said, to buy Tesla, BTI, and more MO to finalize those out over the next year and a half. It's going to take a little bit of patience, but we will get there. I promise. So then we can see in this account, guys, I make $1,235. This will change. Obviously, as I start selling off these positions to put them into my tax or my RRSP, this will change. I think this number will drop, but hopefully as I add these positions to my tax-free savings account, they will grow. And then I'll try and keep 1 to 2 positions in here. I'm not sure what they will be, but I will figure that out. And once they're in here, we will be rocking that way to make about an extra $1,000 a month just off this account. And then, like I said, guys, what I'll be buying in my RRSP will be the Vanguard 500 index fund. This is the Canadian version of the same index that was made only recently, because I think this has only been around since 2012, but this is the same index as the S&P 500 just in Canadian dollars. And we can see if in the beginning of 2012 you bought this, guys, you would have had one hell of a good return, as the S&P has been on one heck of a run. So I'm going to use this And I'm going to use VOO to divide up Canadian and US at a 50-50 split. It might be a little bit more weighted toward Canadian if my TFSA is overweighted US, considering I am buying more US stocks just with Canadian valuations. Again, I know this is sounding confusing, guys, but I won't get into it any farther on that aspect of it. But it's just all in a way to mitigate the Canadian dollar and the US dollar fluctuations. Hopefully this gives it a good even split. So if the Canadian dollar goes up, my U.S. positions will go down, but my Canadian valuations go up. If the U.S. dollar goes down, well, it's vice versa, guys. It's a way of balancing the overall portfolio. And I might even add some bonds. Who knows? Maybe I'll look into adding some bonds to my RRSP here. That might be an option as well. But this is what I think the best mitigated way to balance out my portfolio without over trading it is going to be in the future. And I think this is going to give me a really good diversification into some of the best indexes ever. It's something I've said I should be buying. I say it all the time. Sooner or later, I'm going to buy index funds, but I think for my long-term retirement plan, there's nothing better I could buy than an index fund like a VFV or VOO or SPY. SPY is another one in the indexes you can get. But what I'm going to do, guys, is I'm going to leave this here. I'm going to let you tell me what you think in the comment section below. Do you think this is a good plan? Is there anything I should be adding to this? Is there anything I should be doing otherwise? It's taken a lot of subscriber questions and like a lot of you guys' comments to actually get this portfolio to where it is, believe it or not. This account did not look anything like this even a month ago. You can go check it out. And all of this has happened because of you guys, all of you beautiful subscribers, and along with me learning from a lot of realtors like Grant Cardone, a lot of people like Graham Stephan, a lot of private dividend investors like PPC Ian. There are a ton of people out there to learn from, guys. And as you begin to learn, this is what ends up happening to the accounts. My problem is over trading. I do not like trading as much as I'm trading. I think I am buying and moving around way too many positions too often, and it bothers me a lot. And what I want to do is I want to finalize positions and stop touching them. And then to mitigate out of that risk, instead of setting up a drip system on them, I'm going to use the drip to buy other companies throughout the year. And that way, every year I'll be adding new companies that these companies will be paying for, and I'll start getting a beautiful snowball effect happening, which you'll be able to witness here on this YouTube channel, guys. So I hope you stick around. And I look forward to updating you guys on some other stuff, but I'll do that a bit later. I've got a lot of work I got to get to today. So stay cool, stay awesome, guys. And I look forward to chatting to you real soon.